with all the activities going on in the Trump administration in terms of tariffs, of course, conversations about interest rates, job creation, employment figures, and all that. We really wanted to put together a conversation and a presentation around how those macroeconomic factors can and will and might and probably could affect your small business. There are factors sort of beyond our control, but that doesn't mean that we can't plan for those. So let me introduce Vikram Rai. He is senior economist at TD Bank. He's been there for 3 years. Prior to that, he had a long career at Bank of Canada. He is based out of Toronto, Canada. So he's going to have a very interesting perspective for us about this whole week and what's coming up. A shout out to our friends at New York Regional Business Partnership, NRBP, for introducing us to Vikram because he presented for them as well. So with that, Vikram, I'll turn everything to you, and we're looking forward to listening and learning from you.
That's great. Thanks, Victor. Like Victor said, thanks everyone for joining us. My name is Vikram Rai. I am a senior economist at TD Bank. Here, my focus is on economic risk, but in my past life at the Bank of Canada, I was a forecaster. So I have seen when you're an economist and you're looking at what people expect, oftentimes people think that that takes the form of a forecast of what's going to happen next. And that is a big part of the work we do. But the next part of the work we do that's very important is thinking about the risks around that forecast. Sometimes that's even more important. So what we're going to talk about today, we're going to go through, and this is high level, an outlook for the U.S. economy, economic growth, job market, inflation. We're going to talk about tariffs. That'll come up. I'm sure everyone's eager to know what we have to say about that, and other potential policy changes that the new administration in the U.S. might be looking at based on what they've said so far and what that could mean at a high level, what that could mean on the ground. And I think that where I want to start laying the context here is the new administration has come into is taking office, inheriting a fairly strong economy. Since the middle of 2023, the U.S. economy has been growing above trend meaningfully. And it's not just that it's been growing above trend meaningfully, but that a lot of this growth has been coming from the consumer. Consumer spending has been very strong, particularly in the back half of 2024, where consumers, households really weren't holding back. This is an environment that we expect to moderate in 2025, but the willingness of consumers to spend, the ability of consumers to spend their past wage gains, even accepting price increases, has been a strength of the U.S. economy for the past 2 years. It's worth pointing out too that this is unique. So what I have here on this slide is the expected growth in the U.S. economy in dark green, and in Canada and the Euro area for 2025. And then in the light green, we have 2024. And I want to make two points here. The first is that the U.S. is a standout. So compared to Canada, compared to Europe, if I were to break out European countries here and put them, you'd see sort of a similar picture, which is that the U.S. stands above the rest of the developed world in terms of its economic performance in the recent year or two. The second thing is that the paths are diverging a little. The U.S. recovered fairly quickly from the pandemic. This was part due to the strength of the U.S. consumer. This was part due to extraordinary support from the U.S. federal government. And now we're starting to see that moderate a bit. And we'll talk a bit about what that moderation looks like a bit later. Canada, on the flip side, gearing towards a more delayed recovery, supported by interest rates coming down faster than in the U.S. And Europe is stagnating. Europe is stagnating for a myriad of reasons. If anyone's curious about that, we can get into that after the presentation. But that's not the focus for today, other than to highlight that the U.S. is in a place of strength right now compared to its peers. So what's changed given the new administration? One thing to point out is that all of the potential direction for policy changes have tilted financial markets in a direction to think that U.S. dollar strength is the future. And so, against all of the peer countries, the U.S. dollar has been appreciating since since September, really. Some of that has unwound a bit in recent weeks, but the U.S. dollar still stands quite a bit stronger than it did 6 months ago relative to its major trading partners, the Canadian dollar and the Mexican peso, and as well as the Chinese yuan and the euro. So what this means for day to day is that if you import products from other countries, uh, that costs less. If you are a tourist, your vacations got a little bit less expensive because of this. Um, on the flip side, it means U.S. exports are less competitive, uh, but that may be outweighed by the fact that the cost of inputs is lower when the dollar is stronger. The other big change that we've seen since the election, and this is really stark, is that after the election, you see unified control of the federal government by the Republican Party, and this so-called red wave has led to a rebound in small business optimism, um, on the belief that tax cuts, deregulation are likely to come, and this will make it easier to do business. That said, and this is where we kind of get into where I think there's a lot of questions. So, TD Economics, we put out our forecast at the end of December based on what we knew at the time for what we expected to happen in 2025, given the factors that I've talked about. US households were in a position of strength, balance sheets were strong, wage growth was strong for the prior 2 years, spending and investment had been strong, and this yielded a very strong performance in 2024 for the U.S. economy as a whole. Um, while we expected some of that to moderate in 2025, we had a slowing of 2.8, still well above trend, in 2024 to 2.5, still meaningfully above trend. Now, this chart, there's a lot going on here. So in the dark red, tariffs and tighter immigration, that is what we've taken on in our updated forecast. Somewhat higher tariffs for China are baked into our forecast, and somewhat tighter immigration policy, meaning lower employment and higher wages, so higher costs to businesses to some extent, and potentially less production because some of the tighter immigration just leads to workers that can't immediately be replaced. That has lowered our 2025 forecast to 2.2. This pale red bar is kind of where all the question marks are. This pale red bar of minus 1.8 is what we're calling internally, as we think about the forecast, the worst case scenario. So this is what would happen if the new administration were to escalate tariffs on all major trading partners and dramatically ramp up tariffs on China beyond what we've already baked into our forecast, and much further than they did in the first Trump administration. On the flip side, tax cuts and deregulation, and other measures to improve the efficiency of government, for example, all potentially positive for economic growth. Perhaps more in the long term than the near term, though certainly tax cuts would have a meaningful near-term impact. But the magnitude of that is very uncertain. And so we don't have a quantification of that. I don't think anyone does. But there would be some offset there if that were to come to pass. I mentioned our current tariffs embed mild assumptions, so not the full escalation of tariffs on Canada and Mexico that was being discussed for the past 2 weeks, but a fairly substantial escalation of tariffs on China, and a fairly modest escalation of tariffs on other smaller trading partners. So this pale line in the rest of the world here, that would, that's the Colombias and the Taiwans of the world, where you do see some action from the new administration, and then that's China. But our forecast does not assume that the tariffs on Canada and Mexico, which would be much more impactful for the U.S. economy, would go ahead. Those tariffs are on pause for a month as of, I think, yesterday or the day before, rather. So, I mean, within the next 30 days, we'll see if that actually comes to pass or not. I think everyone in the audience is in New Jersey, so just a couple notes about New Jersey. A colleague of mine is working actually on a report about U.S. states and their exposure to trade because, of course, there's a lot of discussion. The U.S. nationally has a trade deficit. That trade deficit is very large with Canada and Mexico, which means that the U.S. imports a lot of goods from Canada and Mexico, and tariffs on those goods would make those goods more expensive. But they're not all states are the same. Not all states have the same exposure to U.S. trading partners as each other. So if we're talking about New Jersey specifically, on the right panel here, this is U.S. imports from Canada. So that's goods that particular U.S. states are purchasing from Canada. And New Jersey, it's actually fairly low. You can see I've circled New Jersey here. There's several states that relative to the size of that state, have far more imports from Canada than New Jersey does. So in terms of a direct impact from tariffs on Canadian on imports from Canada, New Jersey may not be the most exposed state compared to, say, Maine or Vermont, where there's quite a bit of elevated exposure. That said, some of the effects of tariffs would be felt nationally, regardless of the state's direct exposure, because certain industries like the auto sector, for example, are heavily integrated between the two countries. So this is an anecdote. This isn't data. So it can be taken with a grain of salt, but I was having a conversation with someone who works at GM, and what they told me was that some of their plants in Canada, particular components cross the border 12 times before they're completed. And so a 25% tariff on that component means they just stop making them. That makes auto parts and automobiles more expensive right away. And that would affect GM and Ford and all the major auto producers that have created these integrated supply chains that rely on being able to move things across the U.S.-Canada border fairly efficiently. If Canada were to retaliate to tariffs placed in by the U.S., here in New Jersey is a bit more directly exposed. So there's more relative to the U.S. as a whole and peer states. New Jersey is fairly close to the U.S. average in terms of how much it's exporting to Canada, which is perhaps not a surprise given geography. So you would expect to see a similar impact to New Jersey as the U.S. as a whole. We haven't, and I mean, this is perhaps a bit of a surprise, but we haven't heard anything from the new administration about tariffs on the EU. The EU is the US's largest trading partner after China. It's also the largest economy in the world, alongside the US and China. And so tariffs on the EU would be extremely impactful. New Jersey has a large exposure to tariffs on the EU. So if tariffs on the EU were to enter the conversation, that would be a particular concern for New Jersey. But the other thing to note here, and I think this is important broadly speaking, is that part of the reason for increasing imports from the EU among U.S. states is that U.S. oil and gas exports have increased in recent years. So every U.S. state that exports gas now is exporting far more oil and gas to Europe than they were in the past, because the European Union has had to diversify its energy supplies, given you could say geopolitics. This is in the long term very beneficial for the U.S. because it's a new export market for U.S. oil and gas. So a little bit more about Canada and Mexico. I think we have a selection of trade deficits here. 2023 is the latest year we have full year complete data for. You can see China and the EU, there's a large trade deficit. Number of countries, Canada, it's a bit smaller, but it's still a meaningful trade deficit. Most of that is energy. If you exclude oil, the US is running a trade surplus against Canada. One of the elements of the conversation about Canada and Mexico and tariffs has been about border encounters. I think based on the data, at least, it seems like it's reasonable to think that this is a major concern for the Southwest land border, where that is most of the border encounters that the U.S. Customs and Border Protection deals with. And so perhaps it's not a surprise that this is a conversation that the new administration is having with Mexico. In a trade war. So, I mean, this is sort of where the rubber hits the road. This is the difference in how exposed Canada and Mexico are to the US versus how exposed the US is to Canada and Mexico. To some extent, this really just reflects that the US is a much, much larger country than Canada and Mexico. And so the economic hit to the US for a tit for tat trade war with Canada and Mexico would be much smaller than Canada and Mexico would see. Um, that said, there would still be meaningful impacts. So this is our estimate. On the left side, we have GDP, that's economic growth for 2025 and 2026 in what we're calling our worst case tariff scenario. So this is Mexico and Canada see US tariffs raised to 25% as recently threatened. And the 60% tariff on China, which was discussed during the election, is also enacted. In a world where that occurs, we would see 2025 economic growth essentially go to near zero, and then return close to trend in 2026. So close to a lost year of economic growth. Perhaps more importantly, though, given the uncertainty around economic growth and that there may be offsets to this. So, for example, we don't assume tax cuts and spending plans to boost growth in the face of tariffs being increased by the new US government, but that could happen. So, this point four, perhaps in a world where this worst case tariff scenario were realized, it might be higher. What would not really change is the impact of tariffs on inflation. Inflation was running quite hot in 2022 and 2023, over 4 and 5% in some months. And the size of these tariffs would see tariffs returning to 4% for much of 2025, or inflation returning to 4% for much of 2025 before falling below, in part because of weaker economic activity and demand leading to lower price growth. So elevated inflation for a full year would be the natural consequence of this full-blown tit-for-tat tariff war, this what we're calling this worst-case scenario. So the other area where major policy changes have been floated is immigration. Tighter immigration could be a potential headwind to economic growth, and the reason for that, I mean, there's two reasons. So one is that natural population change has been a smaller source of population growth for the United States in recent years. This is due to a variety of factors, but primarily you have an aging population and a declining fertility rate. So this means that you get less natural population growth. An aging population means that it is harder to finance the pension and health obligations as your demographic pyramid becomes inverted. And so when most countries find themselves in this sort of situation, the natural approach is to try immigration so that you have more working age population for every non-worker. That's kind of the basic economics of why immigration generally has been pursued by countries in the developed world over the last 5 years. And you can see net immigration increased sharply in 2022, 2023, and 2024. It's made up most of population change, and as a consequence, a large portion of labor force growth. We're already expecting this to slow dramatically, but we're still expecting it to be positive. So if net immigration were to turn negative, that would have stark impacts on economic growth. And it's not really something we've seen in the last 40 or 50 years of history. Just turning more to kind of generally where inflation is going. So this is a very busy chart. There's a lot going on here, but on the left panel, we have core inflation. So that's inflation excluding food and energy. And we have the dotted gray is over the past 3 months at an annualized rate. The dotted dark black is over the past 6 months at an annualized rate. And the green, the smoothest line, is what compared to exactly 12 months ago. And the target's 2%, of course. So we only started seeing 2% growth achieved over short time horizons about a year ago. And on average, most of these measures are still above there. So inflation, it still made progress. But 8, 9, 10 months ago, the US Federal Reserve would have expected this green line to be much closer to 2% than it is today. Um, there's been a softening, there's been a slowing in the progress that's been made on inflation, in part because of the strength of the economy. And this means that the outlook for interest rates to come down has been moderated as well. Um, the chart on the right makes the same point and just kind of shows that the real action is in non-housing services. That is the part of inflation that has come down slower. The US saw a real dichotomy in prices last year where goods inflation, there was not really a lot of inflation in goods in 2024. But higher inflation in services showed to be sticky. Um, as households were consuming more and more services and demanding more services, those prices remained elevated and inflation stayed high in services. Shelter is a big part of services, which is why so shelter services means rent, mortgage interest, principally, but also heating for dwelling, and then non-housing services. So we break those down because shelter and rent have been big stories, and it's important to show that even excluding shelter, non-housing services, you see a stickiness in inflation. This stalling in progress means the outlook for interest rates is a bit flatter than it used to be. Um, the labor market, likewise, I mean, we say here it's come into better balance, meaning that uh, it's closer to stability. It's not overheating, leading to increasing wages, which leads to increasing inflation, and it's not falling flat, meaning that people aren't being laid off constantly, and you aren't seeing rising unemployment in a large degree, which would lead to falling wages uh, and the Federal Reserve needing to reduce interest rates or the government needing to put in place policy supports. Um, all of these measures are normalized compared to their pre-pandemic average, so you can kind of compare everything on here to the solid black line. Um, when you're looking at labor markets, it's important to look at a broad spectrum of measures because there's many ways employers can adjust to the labor market being tight or loose. You can reduce hours. You can choose not to hire rather than laying people off. Um, you can choose not to advertise for new positions, or fewer companies can choose to advertise for new positions relative to how many people are looking for positions. So without even changing the number of employed, wage pressures can change. Um, and so that's why it's important to look at a wide range of job market indicators. Probably the most significant here is the large decline compared to the pre-pandemic average in the quit rate. The quit rate, I think, you can probably think of quits as a big optimism index, right? People are quitting their jobs in large numbers. People are pretty optimistic about their opportunities elsewhere. So when the quit rate is high, it's a very strong sign that the labor market is tight. The quit rate now is below average. Um, most indicators are around or a little bit below average, pointing to a softening, but not overly weak labor market. I mean, you can see that all of these indicators, they're below average, but they're nowhere near as far below average as they were in mid 2020 at the bottom. And I mean, despite all of this, hiring still remains healthy. So this is the monthly change in payrolls, um, and the 3-month average is still healthy. Uh, the figure to keep in your head when you're looking at monthly payrolls is that typically you need to see 80 or 90,000 a month to keep up with population growth. So everything above that is net growth. And consistently on a 3-month average basis, the US economy has been there. So that's a sign of a healthy labor market that is approaching stability. So we had a lot of normalized measures about the job market earlier. This is just a direct measure of what's happening in the job market, wage growth. Average hourly earnings picked up strongly post-pandemic. It was a very tight labor market. Um, the flip side of average hourly earnings increasing is that the employment cost index also increased. So this is why um, when economists talk about wage growth, you might think wages going up is very good because that gives people more to spend and everyone wants to see their wages increase. The wages going up also means the cost of employing people goes up. which can mean that the price of goods and services increases, and that leads to inflation. And so that's why you generally want wages and inflation to be stable and predictable, increasing at similar rates, with wages ideally increasing a bit faster than inflation. And we're now in the zone where that's sort of what you can see coming to pass. Everyone, I mean, if you look at the Wall Street Journal or the financial press, you'll see people talk about 2024 as the year of the soft landing, where everything's coming down, and it's coming down at a rate just slow enough to land softly at a point where you can think of things as stable without anyone crashing. And that's, broadly speaking, that's what this looks like. Sorry, that was a little too fast. So the other point to make here is that as income growth is still solid, consumer spending is still solid too. So usually these variables are fairly tightly linked. Part of what happened in the early part of 2024 and in 2023 to some extent is that you had consumer spending far outpacing income growth because households had saved a lot of excess savings during the pandemic. And those balance sheets were being used to support spending as income growth slowed. Income growth has picked up again, and consumer spending remains strong. So this is just very solid footing for the U.S. economy. What this all means is that the outlook for interest rates has changed dramatically. So, I mean, this is important if you have any kind of revolving credit line. This is important if you're looking at renewing your mortgage soon, because the short-term interest rate that the U.S. Federal Reserve sets feeds into all interest rates. Excuse me. So last September, based on futures trading, you would have expected to see interest rates coming down fairly rapidly over the course of 2025. Our latest forecast, which is as of December, had a much more gradual pace of interest rate declines. Though we're still getting to the same place of around 3% at the end of 2026, the pace is much slower, and that means that over this period of 2025 and 2026, consumers and businesses will see higher borrowing rates. The latest market view, which I pulled yesterday, is for interest rates to sort of not do very much over the next 18 months. Just 2 cuts in 2025 compared to 6 and possibly 8 that the markets were expecting 9 months ago. So it's a big change in the outlook for interest rates. It means that higher borrowing rates are likely to linger for longer, as long as this is the outlook for the U.S. economy. We can't go through a presentation about the U.S. without talking a little bit about fiscal policy. So this is a breakdown from this Committee for a Responsible Federal Budget. They put this out during the election, so a big asterisk that a lot of this becomes outdated quickly. And I mean, the new Congress hasn't even started discussing most of this. But all of this was mentioned during the election and by the previous Congress, and is quite possibly on the table in terms of what the administration's priorities might be for spending and revenue. So over the next 10 years, if you look at what all of this would do, it's adding about $8 trillion to the deficit. Another way to look at it, and we'll look at the chart on the right here first. This is the annual budget deficit measured as a share of U.S. GDP. So how big the deficit is relative to the size of the total U.S. economy. In 2024, it was 6.4%. So for every $100 that Americans earned, there was a budget deficit of $6.4. This was forecast to sort of ebb and flow around the 6 to 6.5% over the next several years, but still be a perpetually large deficit. The dotted line here is the average annual deficit for the prior 50 years, which was much lower. Typically, I'm not personally a believer, and I think most economists aren't personally a believer, that a balanced budget is necessary. There is a sustainable deficit that's possible to run a lot of the time. But what that is probably closer to 2 or 3% than 6%, let's say. even if you don't think you need to go all the way to balanced. The numbers that I had on the previous chart, what they would do is they would bring about all of these forecasted years down another 1%. And so you'd be looking at -7.5% budget deficits, and a large increase in the debt, and a large increase to net interest expense being paid by the U.S. government. So, I mean, what this means fundamentally is that that probably won't happen, because it's not a realistic path, and something would have to give. But what that is, we don't know yet. So you can do the budget math yourself, or you can try to. The U.S. federal government spends about $6.5 trillion every year. On the left panel here, we have what that spending is. About half of it is Social Security, Medicare, the Department of Defense, Medicaid, and interest. All of those things are hard to avoid and hard to cut. A lot of the growth in total spending over the last 2 years has actually been an increase in this net interest category, because interest rates are much higher than they used to be. And then finding $1 trillion in spending cuts, which has been the goal floated by Elon Musk and the Department of Government Efficiency, is very ambitious given the realities of the federal budget, because most of these programs are mandatory. They've been authorized by Congress for a very long time, and politically they would be difficult to cut. And even in this other category, which is essentially the rest of non-defense discretionary spending, it used to be about 12% of US GDP, and it's down to about 6% of GDP. This other category has basically been the subject of fairly large cuts in a real sense over the last 10 or 15 years. And it includes things like the Federal Aviation Administration, the federal highway spending, a lot of small programs on their own that it wouldn't really show up here, but they exist and they serve a purpose, and it's hard to find $1 trillion there without giving up something real, is the bottom line. So 1 trillion is an ambitious goal. Let's say this is our website. We have lots of reports. You'll see a couple of reports from last fall about the U.S. budget, about the election. We've put out a few pieces recently on tariffs. We do have a report coming in within the next several weeks on U.S. states and their trade relationships with U.S. trading partners, which could be helpful. And with that, I think I can hand it back to Victor, and we're happy to take questions.
Wonderful, Vikram. Thank you so much. That was obviously very comprehensive. Let me ask you a question just to start off the kind of the Q&A. So let's say if I'm a business owner, a small business owner in New Jersey, and I saw all this data, I'd be saying, wow, this is hard to digest. What do you think? Let's say if I'm not doing international trade, tariffs may not affect me directly per se, but what would be one or two of the key metrics that I should focus on over the next 12 months to really get a good sense of what is happening sort of from a macroeconomic perspective? Is it inflation? Is it the tariffs? Like, what's the one or two aspects of all these conversations that you really feel like a small business owner should focus on? Because, we're busy 24/7 in our businesses.
That's a great question. I think that the big thing is interest rates. So look at the U.S. government 10-year bond yield, because a lot of private credit products, mortgages, are priced off of the U.S. government 10-year bond yield, which means that, so for example, when there's concern about the U.S. budget deficit, the 10-year bond yield goes up. That makes borrowing more expensive for everyone. And that can happen without the Federal Reserve changing their short-term policy rate or market expectations about that changing. So looking at the Federal Reserve, the federal funds rate, and the 10-year government bond yield, and then just look at the unemployment rate, because you're going to get a lot of information about just how strong the economy is from the unemployment rate. Right now, it's around 4.2%. Historically, that's about average or a little bit below average. If it starts going up every month, then you can be concerned. I would say pay less attention to the monthly payrolls report, It makes headlines. It comes out the first Friday of every month. It's very noisy. And pay more attention to the unemployment rate.
Because thank you, that's great. Because one of the challenges here at GNEC when we have a prospective loan client come to us, one of the things that we need to analyze, right, is credit card debt. How does that affect a business, right? And these interest rate changes. I mean, from what you've seen in terms of U.S. credit card debt overall, has the increase. I imagine that the increase in interest rates over the past sort of year that has hampered quite a lot of people, I would imagine.
Absolutely, yes.
Yeah, excellent. Okay. Here's a question we have. Does the SBA count under the other category for the federal budget?
Yeah, the SBA would be in, and with almost every other agency and department that I didn't indicate directly. So I mean, the whole Department of Commerce, Treasury, um, are included in this other, and that would include the SBA.
Well, one question I do have, I noticed that TD has a quite more aggressive outlook on interest rate dropping than I think what the consensus was. Did I read that correctly?
So our current forecast, which is as of last month, is for more interest rate cuts from the Federal Reserve than the market is currently pricing in. Um, Market expectations, I think, are for some more trade action to occur
Mm.
on some front, in some level. We've looked at what other organizations are forecasting, and a number of major forecasters uh, have marked down their 2025 forecast by more than us because they're taking on more or larger assumptions about what tariff and trade policy changes will come into effect. So I mean, we're going to be updating our full blown outlook next month, and at that point, I mean, the 30-day pause for Canada and Mexico will have come and gone, and we might have more insight and more certainty there about that. Um, there are also differences, I think, because um, tariffs, they're negative for economic growth, but they increase inflation. So for the Federal Reserve, that is a complicated thing to respond to because they want higher growth and lower inflation, which means they're getting signals and that push them in opposite directions, and they have to decide what to prioritize. Do they support economic growth, or do they raise interest rates, tamp down on demand to try to control inflation? And it really depends on how they see tariffs evolving and affecting the economy, in addition to, exactly and specifically what is done.
Got it. Great. Got a couple questions here. One is pull out your crystal ball. Do you think the newly appointed leader of the SBA will lower loans for small businesses? Wonder if you have any insight on that.
Um, we haven't seen any specific policy announcements about the SBA. So I think no, I don't really know. I assume you mean when you say lower loans, do you mean lower? I wouldn't expect like action to lower the interest rate on loans for small businesses from the SBA. I mean, that doesn't seem like something that's been discussed yet. In terms of the total lending volume or the existence of programs, we haven't seen any policy announcements on that
Yeah.
front, and I wouldn't be sure what to expect at all.
In some of the conversations around just the CDFI community, there's an expectation that the amount, I mean, and that's his initial, that this will not be an area of cuts in terms of small business support. The administration in the first term was supportive of small business lending. So there's not a massive panic around sort of cuts in overall lending activity through the SBA. But
And philosophically, at least, that sort of lines up with what we think the new administration thinks. Um,
so here's another question. Any thoughts on tracking consumer spending and how to gauge that for small businesses?
it's a good question. So I think there's a lot of things you can look at. Let me just go back a couple slides. So there are a myriad of organizations that publish monthly surveys about consumer confidence, small business optimism, um, the Conference Board, I think the Michigan Fed. You can do a search for consumer confidence or small business optimism and get lots of data at your fingertips very quickly. And it's updated monthly. Um, and that's potentially helpful for small businesses to know because you would think that um, to some extent, that should be a rising tide lifts all boats situation. If consumers are more confident and they're spending more at small and large businesses alike. Um, and then, I mean, the other thing is there is monthly economic data on this. So the U.S. is rich with data, and you can get a good sense of what direction um, personal spending is going from that monthly data. You don't have to wait every quarter for the data to come out.
Understood. Great. No, thank you. One question. Can you clarify the effects of tariffs on small businesses? Do they make importing products from China, Mexico, slash Canada more or less expensive? So we're going to the basics of what tariffs are.
Absolutely. So, I mean, what a tariff is a tax that an importer pays. So if I'm buying a hard drive from Canada, I'm making up a fairly random example here, and it costs $100, and I'm importing it, and then they put in a 10% tariff, then I also pay $10. So it makes it buying it more expensive, and on the first order effect. Now, what this means is that you get a second order effect because now you're the business that's supplying you in Canada um, they have less customers because their goods are more expensive for them. So they probably adjust their price to some extent. And the exchange rate will change a bit too because the demand for US dollars and Canadian dollars has changed because the relative price of goods made in Canada and the US has changed. So it doesn't make it that full 10% more expensive if it's just the final good that's made that way. Um, that's made a wholly in your trading partner and then brought over. But it will make it more expensive.
Mhm.
This gets more complicated when you're talking about goods that are um, manufactured, in multiple stages in both countries and imported and re-exported multiple times, like certain auto parts are, um, where that import tariff might be paid 5 or 6 times. Then it gets very difficult, and it makes them even perhaps more expensive than just what the tariff rate says. But I mean, broadly speaking, tariffs make importing products more expensive.
So as a follow-up to that, and this is in the chat as well, do you anticipate any supply chain disruptions as a result of the proposed tariffs? And specifically, I mean, you mentioned the auto industry, which a lot of people are having conversations about, and it'll be interesting for those who follow the auto industry. Ford is coming out with its financial report this afternoon after the market, and we'll see how they sort of speak about sort of the tariffs. But do you think that there'll be supply chain disruptions, and if so, on what goods and commodities?
So, I mean, autos is always the first example that comes to mind when you're talking about trade in North America. I mean, remember that the history of free trade in North America started off as a free trade agreement around motor vehicles. NAFTA was born out of an auto pact to have free trade in cars and then expanded to cover all goods and then expanded to include Mexico. So trade in this continent has always largely been about cars. The agricultural side, I mean, you could see some issues there too if tariffs were high enough and stayed in place long enough. And then I think, energy and certain industrial commodities like potassium that's used like fertilizer. There's exposure there too. Those are important commodities that the U.S. imports from Canada. Um, so I think that energy, agriculture, autos, probably the big places to look.
I mean, at the end of the day, it seems to me, and this is just my opinion, but the American consumer is the key here, right? I mean, the American consumer continues to purchase, even when inflation was, running hot, and you know, what will happen to the American consumer if he or she says, that he sees that there's going to be a 10% increase in the price of XYZ, and that'll be our decision to make whether we want that at that price or not, right? It's really up to us.
Well, that's true. And I mean, you don't stop shopping just because things get more expensive, that you might become less happy about it. That can happen at the same time.
One last question here. Can they only pick certain goods to tariff?
Yes, and that was part of the recent conversation, where the proposal was a 10% tariff on Canadian energy products, to crude oil specifically, which is imported from Canada, and then U.S. refineries primarily convert that into gasoline, and a 25% tariff on the rest of goods from Canada. In the prior administration, the tariffs on Canada, I believe, were limited to steel and aluminum, so nothing else. So they can be as specific as they want. They could put tariffs only on a specific class of pine lumber, and no other lumber and no other good, and they can put tariffs on everything.
Yep. Great, great, great. Okay, so how soon do you start seeing impacts from tariffs on local level economic issues? That's a good question.
Right away. But certainly within the month, because you would see fairly quickly an impact on interest rates are the first thing to move. And so then even at a local level, everyone has debt or wants to borrow or wants to pay off their debt. And so the movement in interest rates, you feel that right away. Prices you'll start to see within a month. And so then higher prices and higher inflation starts affecting households and businesses within a month or two.
Would you say that essential items are immune to this uncertainty? Additionally, what would you consider as essential compared to luxury? Please share insight on how this uncertainty might impact luxury items or services.
I mean, that's an interesting question. I mean, I guess in terms of essential items, you could think of energy as one of them. Um, what what typically happens when you have something like energy, where you don't really have much say in how much energy you buy. You need how much energy you need. You use how much gas you use. You use how much electricity you use. You can maybe use a bit less, but you don't have a lot of scope. You can't just stop buying gas. And so there, you're going to see a lot more of the price being borne by the taxpayer, by the importer, um, and that'll raise refining costs and raise gas prices. Um, Luxury items and services, I mean, alternatives might be more readily available, and so you might just see, I mean, think reasonably less concern about what happens with luxury items and services because they are luxuries. I think also a lot of this concern is not around. I mean, I'm struggling with this a bit, I guess, because it's a little unclear what would be considered a luxury here from this trade perspective. I mean, certainly higher end automobiles could be like luxury cars would be considered luxury items and services, and they would be affected just like the rest of the auto sector. Um, so not much of a distinction, I think, in terms of essential versus luxury. It's more about whether alternatives exist for consumers.
Excellent. Okay. All right. Well, and we have, our last question here. If consumers add more debt, how can small businesses manage? A little bit of a theoretical, but
Yeah, I mean, it might be good for small businesses actually, because if consumers add more debt, I mean, that debt might be in part to fuel spending. And so small businesses may not be worse for wear if consumers are adding more debt. On the flip side, if consumers are adding more debt to deal with necessary household expenses, and that eats into their disposable income, and they have less to spend, then that is a challenge for small businesses. And I mean, what can you do to manage? I think ultimately it's the same that you would do otherwise, right? It's just being competitive.
right. Awesome. Vikram, thank you so much. This was really a great presentation, something that I think a lot of us needed to learn about and understand. I'm not sure we understood everything fully, right? That takes time. But these are topics that are essential not only to small businesses, essentials to nonprofits like ourselves. Those are all important things to consider. So we really, really appreciate your time, and thank you as always to TD Bank for being so supportive of GNEC, for sure. So before we head out, I just want to mention a couple of things that GNEC will be offering in the coming months. I want to start on March 12th. We're going to have a webinar on small business financial emergencies. That's going to be a presentation with PNC, so you should definitely check that out. On April 9th, we're going to have a Backstop information. Backstop is our technical assistance program, so you can sign up for bookkeeping assistance, website development assistance. We have a very robust technical assistance program. So tune in on April 9th that you can learn more about that. On April 16th, we're going to have a very interesting conversation with Denise Williams of Essex County College. Essex County College is one of the anchor institutions in Newark. So if you're a small business and you're interested in doing business with Essex County College, check this webinar out. She'll walk you through some of the opportunities and some of the processes and procedures for doing business with such an important anchor here in Newark. May 10th, we are going to have our Main Street pitch-off competition. So the application should be open, I think, very, very soon. Check that out. You'll be able to, come and pitch for cash prizes and get to know, get mentored by really smart, savvy, experienced people. And two more things. We are running our Summer Entrepreneurship Institute July 7th through the 16th at Seton Hall University. I think this is going to be our third time at Seton Hall and our fourth time overall. It's a great way to learn about the basics of entrepreneurship for high school students. So if you're interested in that, check out our website at gnec.org. And last but not least, very important, we are going to hold what I believe is the first Newark Small Business Resource Expo. We have about, I think, 16 or 17 organizations that are going to be tabling and explaining what they do and how they support micro and small businesses in our community. So check, pencil that, pen it in. September 17th from 10 to 1, 10 in the morning to 1 p.m. It will more likely be downtown Newark area. We are trying to get Ginsburg Hall. And I think it's going to be really, really worth it to show up if you're a business owner, to learn from the 17 different organizations of what services you can provide. I want you to do us a favor. Check us out on our social media platforms. They're up now. Our website is gnec.org. Facebook, Greater Newark Enterprise Corporation. Instagram, GNECNJ. LinkedIn. Also, as you see right now, these are the QR codes for our social platforms on LinkedIn and YouTube. We do a really great job on providing education through YouTube. So check out some of those video shorts that we provide. And of course, one of my favorites is, if you thought this was useful and you've worked with us and you've had a great experience, go to Google and give us a review. I think that's also important as well. So again, for everything, www.gnec.org. It's 1:00. We promised you to let you go at 1. Vikram, thank you again. And thank you to everyone for attending. With that, have a great rest of your afternoon.